Call debit spreads. What is a call debit spread? This is when you're buying a call option while simultaneously selling another call option at a higher strike price on the same underlying asset with the same expiration date. Why would you use a call debit spread? Well, you'd use this when you have a moderate bullish outlook and you would like a lower cost compared to buying a call outright. Why is it called a debit spread, though? The term debit is used because typically executing this strategy results in a net cost or debit. This means you'll often pay more for the long call than what you receive from selling the short call. These two strategies together end up creating a debit spread, otherwise known as a vertical. So, why is this a beneficial strategy? Well, when you pay for the long call and then you sell a short call, the credit that you get for that short call is going to bring down the overall amount that you're paying overall, which brings your cost basis lower than it would be if you just simply bought the call by itself. When you're looking at what the potential profit and the potential loss looks like, the potential profit is going to be the spread between the strike prices minus the net debit paid, and your loss is going to be limited to the net debit paid. So, if you have, for example, a debit spread that's $5 wide, the most you could ever close that debit spread for is going to be $5. However, you're going to have to factor in what you actually paid for the trade. So, let's say, for example, you paid a $2 debit to get into a $5 wide debit spread, and let's say you close it for max profit. You close it at $5 and you say, Yay, got a max profit. That's great. How much did you make? Well, you spent $2 to get into the trade and you made $3. So there you go. You do not, in fact, actually make the full $5 because you spent $2 to get in, right? So it's going to be a $5 wide spread minus your $2 cost basis. You have a $3 profit. Altogether, that equals $5 on the exit in a debit spread trade, if, of course, your trade was $5 wide. Now, you can also set up trades much wider, of course. You can make your debit spread $10 wide. You can make it $15 wide. You can make it $20 wide. If you have a $15 wide debit spread, then the max you could ever close that debit spread for is going to be $15, minus, of course, whatever you paid to get into the trade. Now, you might also ask, okay, well, then what is your loss? If you're completely wrong, well, if you're completely wrong, the most you can ever lose is the exact amount you paid to get into the trade. So you have, loss potential that is capped based off of the money that you spend. And you do have a profit potential that is capped as well based off of the width of the strikes. Many traders come to us with many years of experience trading stock, covered calls or long puts and calls, but strive to gain experience using complex option strategies. It's our aim to show you the benefits of learning these strategies and the reasons why we use them. Buying in the money debit spreads. The positives include being more conservative than calls. Setting up a proper debit spread enables you to pay less than a call alone to be directionally long. It will hurt a lot less than directional options in the case that your stock trades sideways instead of exploding higher. And you can still make money on this strategy if the underlying trades slowly higher without an explosive move. The negatives include the fact that it's more conservative, but you also cap your gains and have limited potential. You pay less because you're selling a higher price strike when you buy the debit spread, but that higher price strike is where your profits are capped. It does hurt less if you're wrong, but you should still go into it risking the debit paid, just like with long calls. If your strike goes out of the money, then you'll start losing money. Call debit spread, identifying price targets. When you're using a call debit spread, you definitely need to have an idea of what kind of price target you're looking at. Otherwise, how are you going to be able to set up your strikes and expiration series? Here's an example of a Microsoft chart that we were using earlier when we were talking about long calls. In this chart, I'm looking at a few different things. Number one, you can see that it's pretty oversold. The VZO is all the way down here at extreme levels. There's also a squeeze. You're holding up above support at 315, and you're already extended to the downside. So, looking at this chart, I think it's a pretty good shot at saying, hey, you know what? I think it's oversold and it may bounce right back up into this resistance zone. How could I trade that? Well, in an earlier example, we were using a long call. That long call costs about $1,500. Instead of paying $1,500, is there a way that you could set up a debit spread so that you could make this trade a little bit more conservative? Because let's be real, there's a lot of overhead resistance, right? You can see all this price resistance here. You can also see these areas where the moving averages have a lot of confluence. You also have a key psychological value. So, do you think there's a high probability shot that Microsoft is just going to, explode up to 370 right here? Probably not, right? So, it doesn't really make sense to pay more than double for a long call when you could simply pay $6.68 for a debit spread using the exact same idea. So, in this situation, I set up a debit spread and I selected the strikes as 315 and then 330. That long strike is at 315 because it's just slightly in the money, and the short strike is at my target zone. So by putting the short strike at the target zone, which is also the resistance zone, it just makes it a little bit more likely that the price is not going to trade through 330, at least by this expiration series. This expiration series is the 20th of October. You can see that Microsoft has an $18 expected move until the 20th of October. So, you know, it has $12 until it gets to 330. So it is possible that it goes through 330, but I think it's pretty reasonably priced for this strategy. And I also think it's a pretty reasonable idea, especially with that overhead area of resistance, because you have to remember that even with an expected move, it doesn't just go immediately higher or lower $18. Might go higher by $5 and then chop around for 3 days and then trade lower by $2 and then trade higher by $7. It's not just going to go immediately $8 in one direction. So when you're looking at setting up a debit spread, and you're trying to be a little bit conservative, good idea is to also look at the Theo pricing tool. So you might say to yourself, okay, well, what if Microsoft does go to 330? Now, I never try to close out my trades the exact day of expiration. I think it's pretty risky to hold trades that long. I generally close them out about a week or so before expiration because once you get really close to expiration, they start to move pretty quickly, and that can be in your favor, and it also cannot be in your favor. So I generally try to take the easier profits when I have them. So let's price out, what if I hit my profit target, a little bit more than a week early? What would that look like for me? Well, by throwing the Theo price tool on, you can see that these long 315s that are going for, between $10.15 and $10.50 would be going for about 15.67. So what about the ones that I sold? Well, I sold those for, between 355 and 375. They'd actually go up in value. They're going up to 525. That's because I'm setting this Theo price tool to, you know, a good time frame before that expiration date. So when you have this other leg that is still so far from expiration, it's not going to be decaying like you want it to. So that one's actually going against me in this example. But even in that case, this one's going against me slightly because it's not decaying quite yet, and this one's going for me. Well, I'm still making money because if I could close this thing for $10.42, a little bit like a week and a half early, when I paid 668, that's still a profit of $3.47, and that's about, 50% profit. So even when you have a situation where it gets there a little bit early, um, you're not riding it all the way down to the day of expiration, you can still make a pretty decent profit on your debit, which is exactly what I aim to do. The reason why I do really like these is because you have that protection against volatility where if the stock trades higher and it stays inside of the range, like between 315 and 330, you know, you have that situation where you can still wait for that longer call to decay longer. So in this example, if it stayed right around that 330 price or around 325 and you still had time on your trade, you can still hold on to it because that short call would be decaying, right? And even if it actually pulled back, this is kind of the crazy part about debit spreads is that if it went up to the target, let's say 330, it was there too early, started pulling back a little bit, you can actually make even more money because then that long call, or sorry, the short call that you sold will start to decay. So it's kind of crazy because the effects of implied volatility changes can be somewhat offset. So if volatility drops, it may negatively impact the long options value, but it will also benefit the short call, somewhat neutralizing the effect. So, in conclusion, these are really the three main reasons why I like using debit spreads. I like using them when I have a bullish outlook and I want to have defined risk. Call debit spreads are a valuable tool for any options trader, especially beginners who have a bullish outlook and want to find risk. I like the risk to reward. Debit spreads offer a balanced blend of risk and reward, enabling traders to make calculated bets on stocks without the hefty price tag or high volatility nature of single options. And for volatility protection, they also protect against volatility because the decrease in implied volatility may impact the long call's value, but it would actually benefit the short call. So these are all the reasons why I like uh, call spreads. Stick around for the next video series. During that series, we're going to be talking about put debit spreads. And then after that, we're actually going to be talking about credit spreads, including call credit spreads and put credit spreads. So hope you enjoyed this video. Let me know if you have any questions, and I'll see you in the next episode.